morning and welcome everyone to the Share Series Monday Management Update. I'm Cristina Fernandez, Senior Analyst at Telsey Advisory Group, covering the home furnishing sector. And with me today is Clarence H, CEO of Haverty since 2003. The format of today's meeting is a fireside chat, and if you have any questions, you can submit them through the question button on the screen, and I will ask them for you. Clarence is going to start with some brief prepared remarks, and then we'll proceed with our conversation. With that, I'll turn it on to you, Clarence.
Oh, thank you, Christina. Havertys is a chain of 120 stores. We're located in 16 states, primarily in the South. We have stores in the Midwest. We're targeting a better customer, someone who is interested in the better product. Our average sale, for instance, is over $3,300. So we're appealing to a better customer with more custom, more special order. We have designers in our stores, and we think that we're in a good space, not in the promotional end of the furniture business, but where customers are looking to make their home a vision of what they believe in, and we can help them execute that. So we develop our own product. It's Havertys branded product. So we're a branded retailer located in where we believe are the fastest growing markets in the country.
That's a great introduction. So I wanted to start talking about demand and the current environment for the home furnishing sector. So the industry is coming off really strong demand in late 2020 and 2021. Since March, I know it seems demand has softened a little bit. This past quarter, written sales were down 13%, although still up a fair amount from 2019. How do you view the current state of the consumer and demand for home furnishings?
Well, demand definitely softened, particularly in the spring compared to last year, which was up dramatically. And that I'd say started in March and was down for several months. It is still down, our incoming orders, but it's better than last year. I mean, it's better than the first part of the year. It's certainly better than 19. We are down single digits versus double digits. And what's really important to our business today is we're filling back orders. That's the main thing that's happening. So our deliveries are good. We're seeing an improvement in our written business, and we feel pretty good about our position this year. We think with our backlog and incoming orders, our inventory position, which is much better than it was last year, we feel pretty good about this year. We're very conscious that our orders are slightly down, and it's in different areas, but with better position in important categories like case goods, which we didn't have last year, frankly. We feel pretty good about things.
And Clarence, just to clarify, the improvement you've seen to down low single digit from down double digit, what do you attribute that to? Is that a function of the comparisons getting easier, or is it more, the consumer has, sort of normalized spending and maybe return from travel, refocus on their home? Like how are you thinking about the change in trend?
We feel that people are coming back home. I mean, yes, they traveled dramatically this spring and summer. And this time of year, the fall, people start thinking about their home as things cool down. And I think it's coming back to a normal trend. I also think that the fact we're in a better inventory position, I believe, than a lot of our competition. We're able to deliver product. We're able to fill back orders. So both such situations, I think, make people feel better about us and better about their home. So I just feel that there is a trend to take care of your home. Now, housing is not great, but the demand for housing is, and I think people who have a home want to invest in it and make it what they feel it should be. So I think that's some of what's happening.
Yeah, makes sense. And when you're looking at the housing market, the economic data as an indicator of your business, we know existing home sales are down and the mortgage rates higher are not helping, but what data do you look at as a predictor of your business?
Well, historically, it has been new home sales in the South and existing home sales. They're not great. The demand is very strong. I think where we're located is a huge advantage. Our biggest states are Florida, Texas, Georgia, and then the Carolinas, where people are moving. So I really think it's also just who we target. We're targeting a better customer, someone who's over $100,000, $120,000 income, and in some markets it's higher than that. Someone who's interested in customization and special order. I think it's somewhat of who we target. Certainly, the best indicator historically has been new home sales in the South and existing home sales, which is not good. But the demand we know is strong.
So then with that backdrop, as you look to the back half in 2023, do you think this current trend can continue? Is down slightly, a good place to be?
You're talking about this year?
Yeah.
Yeah, no, we feel good about this year. We think we have good visibility through the rest of this year, primarily because of where we are with our incoming orders, our back orders, and our delivery and our inventory situation. Because we do our own deliveries, those are our trucks, our warehouses, our distribution. We understand it. We have very good visibility, even though there are delays, as you well know, at the ports, particularly Savannah right now is a backlog. But we feel good about this year. Next year, it's an unknown. I would say we're not predicting about first quarter, second quarter next year.
Okay. One other topic I wanted to talk about the environment is what levels of promotions are you seeing? We know, at least from our end, we're seeing, pretty heavy promotions when it comes to lower mid-price goods, particularly in mass retailers and online. It seems the higher end, the better product is, not being promoted as much. So I guess what is your view of the state of promotions, and how are you promoting versus last year versus 2019?
I do think that the lower end, middle end is more aggressive than it was at last year. Not many people had to promote last year. We are not cutting prices to be a discounter, and won't do that. Don't believe in that. We do offer more credit promotions and are a little more aggressive this year than we were last year. That's where we put our emphasis, is in the credit promotions. In other words, free credit. And we did that along with most of the industry over Labor Day, which has already ended. But discounting is not in our bailiwick. It's not where we're going. It's not who we are. Or nor do we need to do it.
Switching gears, I wanted to talk about supply chain. I know there's still a fair amount of challenges. It is getting better. So can you speak to the challenges you're seeing right now and where the bottlenecks are easing? Well,
the bottlenecks are at the ports. Getting in the containers. We have a lot of containers sitting out in the water here in Savannah, and certainly on the West Coast also. So getting the product in our facility, even though it's already on the way or already here, is the challenge. We are seeing container rates come down significantly, and we're able to take advantage of some of that. And the incoming orders to these freight lines are weak, so they're trying to make sure they can book business. So I see it improving, but it won't improve probably until the end of the year or maybe into next year. But in any case, I think our inventory situation is in a good position to be able to deliver the product that we have and get us through this year.
What supply chain and inventory improving? How long are consumers having to wait today to get a product, from when they order it?
It's significantly improved. I mean, a year ago, some of it was out a year or 9 months. And now, like for instance, domestic upholstery is down to 6 weeks, which it used to be 6 months or even in that range. So we're seeing all of our suppliers get much quicker deliveries, which I believe is also helping us, particularly in upholstery. We do most of our special order and custom in upholstery. It comes out of North Carolina and Mississippi, and those factories are producing much quicker and able to react to customers, which I think is also helping our business. So that's improving. Now, the orders coming from Asia, they're very soft. They're not getting the orders they need. We're getting the production, but then you've got the backlog and the backup of the containers and shipments at the ports, which is an issue. So getting the product shipped is one thing, getting it into our facility is the delay. Domestic is, as I just said, much better than it was.
And that import product is mostly the case goods, right? Dining sets, bedroom sets. How long is the consumer waiting for that today?
Well, I would say it's back to historic. In other words, if we're out of the product, it's like a 90-day shipment type of thing. But we've got so much flowing today that we're able to give delivery dates. We've got visibility into those containers, and we're able to give delivery dates, but we've got to pad it due to the fact that we don't know how long it's going to be at the port. It's much improved, but not enough to give visibility that's an exact number.
And then another question related with the price inflation or cost inflation that's leading to price inflation we've seen in the category. How have your prices increased the past few years? Do you feel like the prices you have now, can help cover the cost inflation, or you need to raise prices more?
It has been a struggle. I would say if you go back pre-COVID, it's certainly double digit. It's certainly 15% or around that, higher than it was. And in addition to that, we have upgraded our product. I mean, we've gone with more custom, better quality products. So we're selling goods that significantly higher than last year. Now, the inflation has hit certainly in labor, and we've been very effective and aggressive in making sure we maintain our distribution and our delivery people, and we've got now back to full staff. It took us a while, and so we've had to raise our labor rates. I don't see that going down, but I do think it's stabilizing, and I think we can manage that and have been. It is a pressure on margins, particularly freight that was attributed to product that was way out there, for instance, 6-9 months, and now it's coming in. Those freight rates were significantly higher than what we have now. So it is a challenge. We think we can maintain the margins we've had. There are pressures, but I think it's something we can manage.
Yeah, we'll come back to the topic on margins a little bit later, but I wanted to first talk about some of the strategic initiatives you have on their way. One is expanding the store base. You're targeting 5 new stores a year beginning in 2023. What markets are you targeting for expansion? And what is the real estate availability that you're seeing?
Well, it is a challenge getting the stores open. We've had delays for product, in other words, construction product, just all of the issues, the same thing that you have in any other category. So yes, we have a target of 5 stores a year beginning next year, and that's aggressive for us. They're going to be in existing markets and adjacent markets to a distribution where we are. We're in 16 states now. We can serve from our distribution centers probably 2 or 3 more states. We do target growing up the Atlantic coast. We've got a distribution center there in Virginia that we would like to expand. We have delayed that because of some of the price pressures, but we do want to grow where our customers are. And we do really well on the Atlantic coast and in the coastal regions. And so most of these locations would be in either existing markets where we add a store or two, or some adjacent states where we can reach out of our existing distribution footprint. And our main DCs are in, we've got one in Lakeland, Florida, right outside Atlanta, and Dallas, Texas, and now Virginia. So any within that range. We don't want to try to grow outside of that because it's just too expensive to serve those markets.
Thanks. And then another initiative has been your interior design services. Can you discuss, does every store have an interior designer, and what is that doing to your average ticket and the connection with the customer?
We call it our H Design. Our H Design team, we have one in every store. There may be one out every now and then, but one in every store, and in our best stores two. That is really helping drive our average ticket. When we get a designer involved, it doubles the size of the sale. Our average sale is over $30,000. I mentioned that earlier. If a designer gets involved, particularly if she gets in the home, it's well over $6,000. And so that's an important differentiator with us compared to our competition at the promotional end. For instance, Ashley, Rooms to Go. We do more custom work, more special order, and it is an important part of our business. We're emphasizing it. We're marketing to it. It's about 25 to, in some places, 30% of our business. 25 is our target. We're not trying to be a design house, but we offer services for our customers who really need that. And it's free. It doesn't charge. It doesn't cost anything. And we will come in their home and do measurements and help make their home the vision they want it to be.
Yeah, that's very helpful. One other initiative is e-commerce and your website relaunch. When is that going live, and what changes will be visible to the consumer to improve the experience?
The relaunch of our website is the largest project that we've ever undertaken. It's a complete remake of everything we do, and as far as how the customer interacts with us. We are using the Adobe suite of products. It is going to be what we wanted it to be, the best in class in our industry. It's taken longer. It's a major project, and there have been delays. The latest is we'll have it out this year, and it will make it much easier to deal with us, much easier to search for product. We will be able to target customers and let them know things that they've done in the past. Just be able to search, find out more about what we can do for them than we've ever done before. So right now, our web sales are single digit. It's 5 or 6%. We think it'll go to 10% within some period of time, let's say a month to a year. We just want to make it as easy for our customers to deal with us as possible. And they all go to the website. And what we're worried about today is that even though our site's nice looking and tells everything about us, it might not be working easy enough for her to want to interact with us that way. So we're improving everything about that and are excited about it. It's just taken a good deal longer than we thought it would be.
Yeah, no, we hear that happen. I mean, it happens often with these kind of major projects. So, but we look forward to seeing it later this year. And let's shift gears a little bit and talk about operations and profitability, which you alluded earlier. During the pandemic, you made some changes to your operations, particularly working with less staff. Can you discuss what those changes were that it's allowing you to preserve or maintain some of the higher operating margins you've achieved?
Yeah, pre-COVID, we were about 3,500 team members. We adjusted staff. We're now right at 2,800 and doing about 25 to 30% more business, which is why we're more profitable. I mean, it's one of the main reasons, and then the margins have improved too. So a lot of that reduction was in our sales team. We kept our best people. We've cut our hours. We're now closing our stores at 7 during the week, 6 on Sunday. It used to be open till 9. It's allowed us to staff with fewer people, be more productive. Our salespeople today are making a good deal more than they did. So we have our best people on the floor dealing with our customers. We think that helps with our closing rate, which is the highest it's ever been. It's significantly better than it was back in 19. So we've been able to reduce our staff, have a better team who all make better money, and we are able to attract better people that way and keep our costs down. So it is something we're determined to stay with. We don't believe that we need to be open that long, and we won't unless it's the demand requires it. So we've reduced our headcount and are more efficient.
One question related to that we've been asking a lot of companies is, if the economic environment gets worse, there's definitely some fears around recession. What levers can you pull from your cost structure to be able to adjust costs to whatever sales could end up?
Well, we're at full staff in our distribution. I just mentioned that. Excuse me. If our deliveries fall off, that is the area we cut the quickest. We don't expect to do that. We don't see that as something in place that we need to do. But I would say we cut there the quickest. We'd obviously adjust some of our marketing. We spend about 5.5% to 6%, right about 5.5% on marketing. We would reduce to whatever the situation is at the time. And we'd look at our headcount in other areas, including the home office, which, by the way, we cut that about 25% back from what it was pre-COVID. We think that we've got levers that we can adjust there. We also don't believe in being in debt. We right now have somewhere around 140 million in cash. We don't expect to get into debt. That's not in our agenda. And we believe in managing our cash effectively and conservatively. And I think that's important in our industry. We are a cyclical business, just historically. And I don't think our industry can handle heavy debt. And you've seen that happen over and over again. That's not where we're going.
That's good to know. You mentioned marketing, which we didn't talk about earlier. What is your main mode of, or main, I guess, medium of marketing, and has that changed a lot, today in 2022 versus a few years ago?
Oh yeah, it has changed. It used to be almost all broadcast. We're now doing over the top, so that means it's streaming. We do have broadcast, but the largest percentage of our budget today is the digital and social. And we have a new agency we brought in a couple of years ago, EP and Company, and a new marketing lady who's now been with us, I think, 3 years, has done a very fine job helping us understand who the customer is, where they are, looking to drive in new customers, because we think the new customers spend more and are able to understand who we are. So we're targeting new customers. We're trying to address a younger customer. Historically, we've attracted someone in the 50s, early 50s. We're targeting someone a little bit younger, in their 40s. And I think we've been effective with that without losing our existing base. And that's a real challenge, to target new customers and not lose your others. So I think our mix has been able to do that, and more social, more digital than we've ever been, and we'll continue to invest there.
As a follow-up to that, which are you finding is your best source of customer acquisition? Is it social media? Is it the stores? How do you track that?
I think social media is very important for us. We know where our target customer is. We're able to address and find her there, along with the digital methods too. So I'd say we're spending more on social media and digital than any other category. And the second largest would be the streaming over the top. And then behind that would be regular broadcast, which it's just harder to find the cost effectiveness there.
Yeah, that makes sense. We have a few minutes left, so I wanted to talk about capital allocation, which is an area where you've done a lot. You recently, earlier this year, increased the dividend by 12% to 28 cents per share, and repurchased $25 million in shares, and also announced a new 25 million share repurchases. So can you, I guess, high level, talk about how you prioritize capital allocation, and is there a time frame that you see spending this new 25 million authorization?
Well, we don't announce exactly that. I mean, we try to be opportunistic, but the board is in favor of a balanced approach. We believe in buying stock back, and we also believe in dividends. And frankly, it's been pretty well balanced. Last year we did over 100 million. It's pretty well balanced between dividends and stock buybacks. We've done extraordinary dividends from time to time when it works and when it makes sense. We have about $30 million in CapEx that we've done the last year and expect to do about that. And that's the first thing we do. And I look at our dividends. We are yielding over 4 to 5% right now. We have paid a dividend every year since 1935. So we believe in returning capital to our shareholders when it makes sense. And we've been generating a lot of cash over the last several years, so it's allowed us to do that. But we first of all want to invest in our own business and making sure that we've got the best stores and the best operating systems in the industry.
Sorry, related to that, you covered a little bit some of the investment areas, but you do have, a large cash balance, 144 million. Is there a minimum level that the company should have on its balance sheet? And I guess, how do you view maintaining, having this large cash balance in a period of market volatility?
Yeah, there's a minimum. It's not that high. It would probably be in the $75-80 million range of where we think we need to have if we have a recession ahead of us, or just to be able to take advantage of the opportunities. So I do think there will be opportunities for growth for us. Most of our growth has been taking over existing boxes. We do build stores, but only when we have to be able to get in the market. So I think there are going to be opportunities for us, and we want to make sure we maintain that strong balance sheet to be able to do that.
Great. Well, those are all the questions I had. Anything else, Clarence, you want to talk about, or you think it's important for those listening to this presentation to take home?
Just as a recap, Christina, I think we're appealing to a better customer in the best markets in the country. And that's our strength, and one that allows us to grow and maintain margins and build our brand. And I think the years ahead will be better than the ones in the past. So we're excited about our potential and our opportunities.
Great. Thank you for that. And thank you everyone for listening in. This concludes today's presentation. Have a great day.